Hi, everybody. I think we're going to get started. And I am going to ask everybody to mute here because we're hearing some noises. But welcome. Thank you so much for joining today. Financial sustainability for Giving Circles, building viable options beyond member dues. Please note there is going to be closed captioning available, and it can be enabled at the bottom of your Zoom screen. My name is Sarah. I'm the CEO of Philanthropy Together, a global initiative to grow and strengthen the field of giving circles with programming like We Give Summit. We're so excited to discuss this issue and having these three or powerful women from Philanos affiliates to share their wisdom, because I think all giving circles are always thinking, how do we become sustainable, right? So throughout today's session, please engage with us in the chat. We also encourage you to share your feedback following this session. There's going to be a 2-question poll. So with that, I am very, very happy to introduce Deborah Majewski from Women's Impact Fund. Thank you, Deborah.
Thank you. Appreciate it. Welcome, everyone. Thank you for joining us today. As Sarah said, I'm Deborah Majewski. I am going to be serving as the moderator for today's session. I serve on the board of Philanos, and I'm a proud member of the Women's Impact Fund in Charlotte, North Carolina. I'm joined today by 2 fellow Philanos board members, Rebekah Bonde and Clare O'Brien, who will be serving as our panelists. Both panelists have considerable experience in both the corporate and nonprofit sectors, and I'd like to tell you more about them. Our first speaker is Rebekah Bonde. Rebekah is the treasurer of Philanos and a member of Washington Women's Foundation in Seattle, where she serves as a leader on collective grants committees using trust-based philanthropy practices. She's also the past chair of the board of directors of Impact Austin Foundation. In her board leadership positions, Rebekah has chaired the audit, finance, personnel, and governance committees. Previous board service includes Street Youth Ministries, Sammamish Rotary Club, and Women's Enterprises, all based in Seattle. And she's a committee chair-elect for the Lyric Opera Circle of Kansas City. Her work in women's philanthropy has been featured in network webinars, conferences, local media, and in the Huffington Post blog. Retiring from a career in corporate financial analysis, Rebekah and her husband, Paul, started Bonde Consulting, boutique firm providing financial consulting services to client families and nonprofits. Rebekah holds a BA degree in international business and a BBA degree in accounting from Abilene Christian University, minors in economics and French. Our second speaker is Clare O'Brien. Clare serves on the education committee of Philanos and is a member of Impact 100 Cincinnati, where she previously served as treasurer and grant committee chair. In her community, Clare serves as board chair of May We Help, a nonprofit which makes customized assistive devices for individuals with disabilities. She is a member of the global leadership team of Stanford Women on Boards. During her business career, Clare held senior leadership roles in marketing, strategy, and sales in high technology and financial services companies, including vice president of marketing at Fidelity Investments. Clare graduated with a BSc in mechanical engineering from Princeton University and a master's degree in management from the Stanford University Graduate School of Business. She also holds the Chartered Advisor in Philanthropy designation. I'm grateful for Rebekah and Clare agreeing to serve as our panelists today. Next slide, please. All right. During today's discussion, we'll review how traditional resource development and alternative fundraising can help create financial sustainability. Our panelists will talk for 15 minutes each, and we'll save 15 minutes at the end for Q&A before we wrap our session. If you have a question for the panelists, please use the chat function in the Zoom toolbar at the bottom of your screen. We also encourage you to use the chat function for comments and information sharing throughout the session. Now, we want to learn a little bit more about the giving circles you represent, and we have a brief poll that we invite you to participate in. Can we get that poll launched? Awesome. Don't fret if you don't know the answer to a question. Just go ahead and you can either skip it or take a guess. There are 4 questions, so you may need to scroll down using this right thing on the side of the poll. And I'm going to be quiet and give you a couple seconds to complete the poll. Okay. Hopefully you've all had a chance to complete the poll. If not, you can continue, but I'm going to move on at this point, and then we'll bring the results of the poll back in a bit here. Now I wanted to share some basic, thank you, next slide. Now I want to share some basic information about the affiliates that our presenters represent. As noted earlier, Rebekah is a member of the Washington Women's Foundation. It was established in 1995. It operates as an independent 501c3. As of the end of 2020, it had 367 members. Membership dues there are $2,500, 80% of which goes to the grants pool and about 20% to operations. It has 4 full-time employees and 1 part-time employee. Next slide, please. As also noted earlier, Clare is a member of Impact 100 Cincinatti, which was established in 2001, also operates as an independent 501c3, has more than 5,000 members, and has 2 different membership due structures, $1,000 for a full membership and $500 for a half membership, with 100% of that funding going to the grants pool. It recently instituted an opt-out 110% membership and has 1 part-time employee. Can we get the poll results back on the screen, please? Great. All right, so we can see here that the majority of the folks being represented here are part of independent 501c3 organizations, with a third being hosted by their community foundation. Oh, wow, and most of them are experienced with more than 8 years in existence. And then membership, how many members do you have? Question number 3, you can see that a good portion are in that 100 to 300 member area, with a fair amount with 300 plus as well. And then in terms of the support structure, it looks like most are all volunteer. Kudos to you guys. That's a lot of heavy lifting. So you can go ahead and click on the bottom right corner there where it says close and make this go away. And we'll move on. And with that, I'll turn it over to Rebekah.
Hello, Nancy, next slide, please. Thanks, Deborah, for the introduction. I'm going to start by saying that this is one of my favorite slides in the entire presentation, because you thought starting a collective giving group with an all-volunteer army, which most of you have, of highly skilled members would be inexpensive. And it is, but only on day 1. And wouldn't it be great if we could just close our eyes, click our heels like Dorothy in The Wizard of Oz, and just wish for the money to pour in, because we hoped it would. If there's anything I've learned in over 20 years of serving as treasurer in various nonprofits, including giving circles, it's that hope is not a strategy. Today, we're going to talk about best practices to build financial sustainability at each stage of your group's life cycle. We've divided up each stage as forming, 1 to 3 years, maturing, 3 to 8 years, and established as 8 years or more. Now, these designations are just an average. They are not meant to dictate to you or judge you where you are. You may be a young group that has grown so quickly that you're experiencing issues that a mature organization has. And conversely, you may be a group that's been in the community for many years, but you're still wrestling with issues as if you were forming. So please take our labels with a grain of salt and don't read any judgment into it. Let's begin with foundational considerations for each life cycle stage. Next slide. Now, any discussion about financial sustainability starts at the base of the pyramid at budgeting. You can't know where your organization is heading unless you first master the practice of building and using a spending plan. So many collective giving circles have adopted a let's hope for the best approach to running their finances. I'm here to tell you that hope is not a strategy. We would never accept this attitude in organizations applying for our grants, and the nonprofit world is littered with groups that had great intentions, but bad financial execution. So let's review some budgeting basics. The first and most important question to ask is, how much does it cost to run the organization, and how are we going to pay for it? If you cannot identify a source of income or donation to pay for an expense, then you simply can't afford it. The second is when. Perhaps you do have a way to pay for an expense, but the timing is off because you receive the revenue months after the expense is incurred. You have a cash flow timing issue that needs to be accounted for in a budget by matching the cadence of spending with receiving funds. And the third question is who. Your treasurer should not be the only financially literate member. The board cannot be the only financially literate body. It is every member's responsibility to understand how the organization is financially managed, and it is your board's job to create a culture of financial transparency. When your membership has a solid understanding of the funding needed, even with an all-volunteer army, you have planted the seeds for donor development within your membership. Now, the second stratum on this pyramid is staffing. Who is going to do what? You will need to identify a treasurer who is skilled in budgeting, reporting to the board, knows how to add, and cares that the financials are put together properly. You would be surprised how this last trait is not ubiquitous to all treasurers. You do not necessarily need your treasurer to be a CPA or financial professional because there are good cloud-based software programs to help with GAAP-related items. But you do need someone meticulous and detail-oriented and who is unafraid to say to the board, no, we can't afford to do that. Once you have these practices and people in place, we can now have a discussion about reserves. Industry best practice says reserves should be a minimum of 3 months of operating expenses. According to the Council of Nonprofits, less than 25% of nonprofits had 6 months or more of reserves, and 10% had only 30 days of operating costs saved. Some collective giving groups ask, why should we have reserves? Our role is to make grants, not run a traditional nonprofit. Well, if you assume everything goes to plan, then you don't need them. But guess what? There are going to be circumstances and events outside your control that will impact your group's ability to meet its obligations. I've been a part of a group where a handful of people reneged on their pledged gift at the 11th hour of grant making, and we had to scramble to locate a replacement. Reserves buy you time, and you won't have to panic or scramble. Next slide, Nancy. Now, after your organization has mastered the basics of budgeting and created a culture of financial transparency, a group in the maturing stage should consider the following. Have your costs increased? Has the work gotten so big or complicated that that volunteer army is burned out? Is it time to hire staff? Are you thinking about a long-term time horizon for your group? Is it time to start thinking about creating an endowment? If yes, what kind of endowment are you going to create? When you're in the established organization stage, you still manage revenues and expenses because it's a core discipline in financial best practices. Budgets become strategic at this stage as you think and enact that long-term strategic plan. I know of an organization, believe it or not, who's already asking the question, what does 2050 look like for us? Next slide. Now, people assume that accountants make good treasurers, as we talked about roles and responsibilities. And they can, but a good treasurer and finance committee is made up of meticulous, numbers-oriented individuals. One of the best treasurers I've ever known was not a CPA, but an attorney. So do not feel limited by the professional designation in your group. Look for key characteristics instead of a specific profession. In the forming stage, the best treasurer is one who understands the importance of capturing the total cost of the organization, the timing of when revenue comes in and when bills are due, and again, someone who knows how to add. In the maturing stage, you're getting bigger and older, and your needs have changed. You probably do need to be looking for a treasurer and a finance committee with advanced skills. You are starting to encounter transactions that have longer term consequences and legal ramifications, like a more robust 990 filing, issuing an annual report with financials, maybe an audit, maybe going ahead to create that endowment. Endowments that are housed externally, like at a community foundation, require a thorough reading and understanding of the fine print from a legal perspective. And established organizations absolutely need financial professionals to serve as treasurer on the finance committee, the audit committee, the investment committee. You get my drift. Next slide. This is a snapshot of reserve levels per life cycle stage. Take note that the higher the run rate or expense budget of your organization, the more reserves you need. Remember to start at 3 months minimum and work your way up to 6 to 12 months. By the time you're in that maturing stage, you will need to create a reserves policy if you haven't already. We'll talk about in the next slide. And if you're established and have staff, you need more reserves as we have indicated. Next slide, please. Creating reserves starts with 3 basic categories. First, considerations like the volatility of your revenue stream, which is usually membership renewals. Do members renew each year? Are there multi-level commitments that are pretty steady? Do members pay in installments? All of this impacts the timing of your cash flow. Consider also the complexity of your group. Are your expenses more variable or are they fixed in nature? Next are strategies. Strategize how to build those reserves. You can either create a line item in your budget to save for reserves, or you can create a campaign to build reserves through special donor solicitation of your members. And finally, what does this policy actually look like? Now, there are so many open sources you can use to gather best practices to write your own policy, but I'd be happy to share and discuss some of those with you at our Let's Keep Talking session tomorrow. My one-word advice is to identify what events will trigger the use of reserves and what won't. Agree ahead of time. Next slide. Okay, let's change. Let's start talking about funding sources. For collective giving organizations, that to increase your revenue so you can begin building reserves in the forming stage. You should, at this stage, you should be, at the very least, be soliciting your members for donations, especially your founding members, because they have the deepest attachment to your organization and want to see it succeed in the long term. The next thing to consider are donor advised funds. Educate your members who have brokerage accounts to open a DAF, like at Fidelity or Schwab Charitable, to pay for their membership and an extra donation at the same time. It's pretty painless to tack on extra money when you're giving from your fund. Third, matching gifts. Be an advocate for the workplace matching programs your members can take advantage of through their employer or their spouse or partner's employer. And finally, the best source of in-kind donations come from your membership. Don't overlook what may be right in front of you. But remember, these in-kind goods and services may not be available to you one day, so budget as if you have to pay for them. Next slide. One way that organizations in the forming stage can fund their expenses is to require annual membership fees. And as you can see from the slide, this can be a tricky seesaw. I know this firsthand because I was on the board at Impact Austin when we implemented the practice of requiring membership fees for the first time. And I spoke about that at an earlier Philanos conference. When extra donations are voluntary in your organization, like 110% campaign, which Impact Austin had, you've opened up the opportunity for members to donate. But it's not an informed way of educating your membership about the expenses required to run the group. Also, you haven't really solved that budgeting conundrum because you don't know how much people are going to give and how many are actually going to give. And I'm just going to say that some members who are really generous sometimes feel a sense of specific ownership about how the generosity of their funds are being used. This can negatively affect the power balance between the board and the donors. Required membership fees ease the budgeting process because you now know the minimum that members are going to contribute. It democratizes the funding process because each member equally contributes to the organization just as they do to the pooled grant fund, which significantly reduces any potential power imbalance. This model works best when you've created a culture of financial transparency so your membership understands the true cost of running the organization. It's clear I prefer this method because it holds true to the spirit of collective giving, that no matter where we come from in life, we come to the giving table equally, especially when it comes to supporting our home giving groups. And now I'm going to turn it over to Claire for the next section.
Hello, I'm delighted to be here today to share some ideas and programs that have increased our financial sustainability at Impact 100 Cincinnati. I'd like to begin with a personal story. I have two sons, and several years ago, as they got summer jobs, we needed another car. After much research, we acquired a battle-tested, meaning used, Honda Accord. While I think they were hoping for something a bit flashier, I told them that the car was capable, fun, safe, and easy to maintain. And also, as they got more established in life, they could always upgrade. I think that's a good analogy for what I'm about to present today. Proven vehicles that are fun and engaging for your organization, safe for your assets, and easy to maintain through multiple transitions, since most of us serve on all volunteer boards. I like to describe this as a menu of options that each organization can choose from, depending on what fits their situation. And for context, Impact 100 Cincinnati has no mandatory fees and needs to raise roughly $70,000 per year for net operating expenses. So as we move to the maturing phase, I'd like to touch on sponsorships first. I enjoyed working with our development chair on building our program because there is a lot of room for creativity and fun. By bringing both structure and energy, we were able to raise it from a revenue source of around $5,000 per year to over $30,000 per year, and have maintained that level for several years now. There were three main elements. The first being people, identifying the point person, often the development chair or president, ideally someone with past development or sales experience. And then ensuring full board support, because as our development chair likes to say, sponsorships are a team sport. We created a formal benefit schedule, which included three categories: event participation, company visibility across all channels of communication, and event inclusion. In parallel, we developed a cover letter with sponsorship and donation options and contact information. We prepared some high-level demographic information on our members to demonstrate the value to the sponsors. We then began an annual cycle where we had all board members send the packet along with a personal note to their contacts. And then the development chair followed up with interested companies to close the sale. We collaborated with the sponsors on benefit delivery with customized events and approaches for our largest sponsors. Over time, we built multi-year relationships with companies, foundations, in-kind sponsors, and individuals. Next slide, please. Here's a sample benefit schedule, ranging from $1,000 to $10,000. You can see different types and levels of digital media and in-person exposure. Some of our customized events included a financial literacy event to educate women on charitable giving with Fidelity Investments. And then on the other side, an event hosted in a newly renovated jewelry store. For the last few years, our title sponsor has been a member's heavy equipment company that just wants to support our work and asks for nothing in return. To help with nonprofit capacity building, we brought on in-kind sponsors that offered free presentation coaching to our finalists and nonprofit financial training. Next slide, please. Grants. These can be less predictable, yet still a good source of revenue. Each organization will want to assess the landscape to evaluate if it's perceived as competing with local nonprofits. You can seek grants for topical issues which funders want to support. And for us, we had two areas. The first was our DEI work. And here I'm showing a promotional graphic for our equity cohorts, which helped our members learn about DEI issues. They were facilitated by women of color in discussions centered on resources like documentary series, books, and movies. Everyone, including me, learned so much from these discussions, and it has helped us evolve our organization and grant making. We've received multiple grants from our local community foundation and Philanthropy Together for this work. On the right side, several years ago, we piloted a Young Philanthropist program for women under 40, which was well received and growing in popularity. We wanted to make it permanent and expand the scale. We found a local foundation focused on women and girls and secured a $100,000 donation to endow the program in perpetuity. Here's a picture of our 2021 class, and I'm proud to say the program has grown more diverse as well. As your stature rises, your organization can explore regional and national grants. Next slide, please. Those were some externally focused options. Let's turn our attention to some internal options. The applicability of these techniques will depend on your giving circle's size and payout schedule. Impact 100 gives out around $400,000 per year, and the funds are dispersed within 3 years. At any given time, we have between $600,000 and $1 million in restricted grant dollars. When I started the treasurer's role, we had only about $30,000 in cash reserves. So to Rebekah's point, less than 6 months. So I investigated safe, meaning insured ways to put the restricted money to work. So I'm going to talk about 2 short-term investment options, which are highly relevant given the rising interest rates. Money markets offer a modest return on cash and great flexibility. We identified business bank account options with competitive rates, which can be challenging as business rates are often lower than consumer rates. As socially responsible investing gains traction, local credit unions are also an option for mission-aligned investing, as those funds are loaned out at favorable rates in the community. In either case, you'll want to maintain your accounts below the FDIC or NCUA insurance limit of $250,000 per depositor per institution. Because we had several $100,000 spread out over multiple banks, we decided to consolidate our deposits through a single bank that had favorable rates and offered access to a service called intra-FI network deposits. Here, you maintain a single point of contact with one bank, and any funds over the $250,000 limit are farmed out to other banks in the network in increments of under $250,000. This way, all of your deposits are fully FDIC insured, you have easy access to the funds, and only one relationship to manage. Next slide, please. Another option for short-term funds is brokered CDs. For anyone who's not familiar with these, the brokerage firm acquires CDs in large denominations and divides them into smaller amounts for their customers, usually in increments of $1,000. FDIC insurance applies to each issuing bank, so as long as you keep the amount per bank under $250,000, you can keep a portfolio of CDs from different banks and of varying maturities in one account. We leveraged the broker relationship and account we had for donated securities to buy and hold the CDs, which simplified our record keeping. We reviewed the process and the attributes with the broker before starting to purchase. With interest rates rising, this is becoming attractive again, and in some years we were able to earn over $10,000 in interest income. It is important to match your grant and seasonal cash flow needs for events or other purposes with any CDs you purchase, and to maintain a cash buffer in case things change. We typically try to keep maturities under 9 months, and here is a recent example of what the rates are. And in a rising rate environment, it's actually best to keep them a little shorter so you can roll them more frequently to keep up with the rising rates. Next slide, please. Now we'll move to the established phase. As a giving circle matures, it can consider more complex ways to build financial sustainability. In both cases, we took the approach of building something capable, yet easy to maintain. So the first item I will cover is the endowment, which is a fundamental building block. There are two approaches to an endowment account, and regulations vary by state, so it is important to do the research before making a long-term commitment. The first type is a true endowment, which is subject to regulations called UPMIFA. This has 3 parts. The first, that regulations vary by state, and then there are guidelines for the investments of assets and as well as the distribution. The second is a board-designated endowment, which is a permanent long-term investment fund. Ours is the latter, which we created through a combination of donations from sitting and past board members and excess reserves. This fund is controlled by the board and not subject to UPMIFA. You can have multiple long-term investment funds. For example, for our $100,000 YP endowment that I spoke of earlier, I set up a separate fund to facilitate tracking and reporting. A key element of the endowment is the investment policy statement. We had a very strong committee with women who had investment management, tax, financial planning, and management expertise. We've since then added an attorney and periodically review the policy and update as needed. Next slide, please. There are several elements. The first 2, the purpose and philosophy and the general objectives, you can craft for your own purposes. The meat is really in the next 3. The Finance Committee responsibilities, which are to set the guidelines and limitations, select the investment manager, monitor the fund, and communicate results to the board. For our investments, we chose a Vanguard balanced fund, which was 60% equity, 40% fixed income, with a low expense ratio, which has performed well over time and automatically rebalances. Our performance objective is that over time, the return should exceed the sum of inflation, expenses, and the spending rate. Our spending policy is that it's optional to take a distribution. And in the years that we do, it should be no more than the 4% rolling 3-year average. We can take extraordinary distributions if needed. Next slide, please. The next thing I'd like to touch on is planned giving. So per the website Nonprofit Next, the technical definition of planned giving is any major gift given, either during the donor's lifetime or after death, is part of the donor's overall financial and/or estate planning. Planned giving can include bequests, gifts of appreciated stock, real estate, artwork, life insurance, and retirement plans. These are gifts from the balance sheet, not the income sheet. Equally as important, though, is the emotional part of planned giving, which is helping people reflect on where their passions lie and what kind of lasting impact they want to have in the world. It's really about forming a partnership between the donor and the organization. So it's vital to focus first on the why, then the how. A planned giving program requires a long-term view, as there is work up front and ongoing, but the benefit typically will be at least several years away. Done well, planned giving can have a substantial impact on an organization's sustainability. I'd like to talk about how we created a planned giving program, which we called the Impact 100 Legacy Society. The first step was to demonstrate organizational longevity and stability, so people had the confidence we were going to endure and keep our promises. We launched this in our 18th year. We already had an endowment in place to receive these gifts. We then created a policy specifying the types of gifts, and we chose to only accept direct bequests, which are financial disbursements, as we did not have the staff and infrastructure to handle more complex giving options, again, making it easy to maintain. However, if you have the expertise and relationships, you can choose to accept and dispose of more complex assets. As one expert advises, never accept a gift that eats. I think he means that both literally and figuratively. The purpose of the gifts. In our case, the default is unrestricted, or the donor could specify endowment or grant funds. Documentation. We require written notice from the donor that they have made arrangements in the estate plan. Recognition. We started out thinking that we would make this public, but the donors requested that it be kept private. We then developed an informational brochure which outlined the why, an opportunity to align a woman's passion for collective giving and Impact 100 with the ability to make a lasting difference. We explained the elements above and included some sample bequest language that could be used in a will. It was very simple, really only one sentence. For our initial outreach, we identified people who might be interested, such as former board members, women who volunteer and attend events regularly, and individuals or family members who make additional annual contributions. Personal attributes included those with established giving vehicles, donor-advised funds, as Rebekah mentioned, or family foundations, or other assets suitable for giving. Ideal prospects are loyal, educated, 70 plus, and have funds exceeding their lifetime needs. Research has also shown that some of the most generous are childless. So it's important to educate and plant the seed for the long term. We held a kickoff event with board and potential donors, and we're excited to receive confirmation of several significant commitments soon after. We aspire to maintain annual contact with the planned giving donors to express our appreciation and ensure plans remain in place as wills are revised. As the expert Dr. Russell James says, we should take good care of our oldest friends. Thank you. With that, I'd like to turn it back to Deborah.
Thank you so much, Claire and Rebekah. That was really good information. At this point, we're going to transition to Q&A. So if you have questions, as a reminder, please put them in the Q&A section down below on the Zoom toolbar, bottom of your screen there. At this point, we have no questions, but we did have some questions submitted in advance of our session that I will start to go through while we see if there's other questions. First question, and this can go to either of you or both of you for that matter. Do your respective affiliates charge members and or guests for events?
I can take that one. So we started out by making all our events free, but as we grew in size to 300, 400, 500 members, we did have to start instituting a cost to cover at least what we were paying. So we weren't making money on it, but it covered our costs.
Yeah, when at Impact Austin at the time, we did not charge for events, but our Claire and I chatted before the session, and our events were a lot different. Claire's group has a beautiful sit-down dinner. Ours was like turkey wraps from the deli, so there's a little bit different costs there. At Washington Women's, I don't believe that we charge. I actually haven't been to an in-person event. But that's part of that membership fee kind of goes into paying for all of the costs of running the organization. So you kind of pay one fee up front instead of charging bit by bit. But for what we know of every group is just a little bit different. And there's kind of a mix represented of both modalities.
Great. Thank you both. Another question is, Rebekah, you referenced at the beginning, making sure that membership is educated about the finances of the organization. Do you have any tips on how to actually make that happen?
I think the best thing to do is at your whatever annual meeting you have, where you have the bulk of your members there. Maybe it is your grant celebration. Maybe it is a state of the group. Maybe it's your discovery day. Whatever that happens to be, take the opportunity to throw a couple PowerPoint slides up there when you're having your in-person event to talk about exactly what the group looks like. It can be a simple pie chart. It can be just a really simple spreadsheet with some numbers on there so that each member has the opportunity to see the cost of your organization and what it takes. What you're trying to avoid is any sort of plausible deniability of members saying, I had no idea. They never talked to us about it. And even though in newsletters, we as treasurers, and there are a lot of treasurers in this group today, we probably beg to put something in a newsletter or on a website. The truth is, people don't usually voluntarily go to that information. So take full advantage, 3 minutes at whatever those meeting venues are, and go ahead and give them some information and start educating your members. It starts there. And then I think for treasurers, and Claire, pop in, for treasurers and anyone on your finance committee, welcome the membership to ask you questions. Always be available and very transparent and honest about answering questions, and welcome that. I think creating that atmosphere is really important.
Yeah, I echo everything that Rebekah said. And I think it actually starts with the board. I find as the treasurer that you have to educate the board on where the expenses are, where the revenues are, where the expenses are, and then to use every available channel, whether that's your newsletter, whether that's in-person meetings, whether that's, smaller groups, where you can talk about what it costs to run the organization. And we found that after doing that, we got some unsolicited gifts, a $10,000 gift to the board to use as we desired. So, again, I think women are very generous in the group, and sometimes it's just a matter of explaining to them, how we need to support the operations.
Excellent, thank you. All right, we have a question here. At what point did you decide to hire staff? Was it based on number of members, amount of donation dollars?
For Impact Austin, we hired staff when that all volunteer army was completely burned out, said, we can't do this anymore. What are we going to do? We want the organization to get bigger, 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 do more things, but we can't do it anymore. And at the beginning, we did rely on the generosity of several members to go ahead and start funding for paid staff. And we hired an executive director and kind of like put a lot of those volunteer tasks on her. We still had an all volunteer army. Absolutely. She couldn't do everything, but that was based on kind of a very sober assessment. And again, not just creating a culture of financial literacy, but a culture of openness and talking to leaders so that they can listen to what members are saying and what volunteers are saying, that I can't do this anymore. I remember being the financial administrator, entering receipts on Christmas Day night because they had to get in before the end of the year. That's not fair to ask your volunteers to continue to do that. No matter how enthusiastic you are, that's just not right. So I think each group has to have a very sober assessment of what their members are really willing to do and no longer willing to do. And then you start kind of going down the numbers there, and what is it going to cost to do this? And do we want to rely on the generosity of a handful of people? And it's fantastic if you can get that big $10,000 gift. That is a wonderful thing to have. A lot of groups don't have that. And so you're going to have to decide, if we can't afford that, then what are we going to do to scale down so we can do something that is sustainable for our volunteers?
Claire, you have less staff at Impact 100 Cincinnati. I have one part-time person. What was the decision-making criteria to add that person?
That actually preceded me. And so we've had a part-time person for many years. And I think it was, to Rebekah's point, we had too many administrative tasks, and too many payments to process and too many letters to send for the volunteers to be able to manage that. We have also had some additional discussions about, are there some functions we could outsource, whether that's bookkeeping or event planning? And then we did add a couple of extra members to our board to give it a little bit more capacity. But there's also a limit too, I think, there that you reach.
Right. Thank you. All right. Another question is, have you found a give a gift that is personally significant versus a set amount to be successful? And what are some potential pitfalls associated with that?
Boy, again, it's like that slide I put up with the little seesaw. We want to, I think we're much more aware and rightfully sensitive about where people are, and that a gift that is personally significant to one person is not the same as it is for another person. I'm always reminded of people who have to save all year to be a member of their giving circle, and it's sacrifice for them to take out that $100 a month or whatever it happens to be to participate in the pooled grant fund. Whereas some members maybe have $2,000 sitting around their couch, right? Where we come from such a diverse economic pool. So I think that you want to definitely be sensitive to that. But from a budgeting perspective, maybe it's a matter of asking your members, can you commit to paying your share of it? So if you have 250 members in your organization and it costs, I don't know, $50,000 to run your organization, can you as a member commit to paying 1/250th of that as something that is personally significant to you? That's one way of just mathematically coming up with it. I know that I've been in groups where we do have that personally significant gift, and I will be honest with you, it is still really difficult to budget with that. And that's just something, again, I think you're going to have to work with your membership on and tell them, when you're working for an employer, are they willing to pay you a salary that is personally significant to them? And that doesn't necessarily work for you, but it is tricky with giving groups, and we're trying to build more economic diversity in our groups, but we still have an organization to run. Claire, do you have any better insight than what I was able to give?
Yeah, I guess I have a question for Lindy. Is she talking about membership levels or gifts beyond that? If it's membership levels, I think having set benchmarks is helpful, just because otherwise the administrative burden. Okay. So we actually have two membership levels. We have a $500 and a $1,000, and it's actually not restricted by age or any other situation. And that's been interesting for us because it creates the same amount of administrative load for a half member versus a full member, but we've decided to leave it that way to encourage both age and racial diversity. In terms of giving a gift that's personally significant, I think that might be language you could use with the board if they have to make their membership donation and then asking board members to make an additional gift to support the organization. It could possibly be as a personally significant gift.
Claire, there was a follow-up question there. It says, do the $500 members have full voting rights?
They have a half vote.
Perfect. Okay, great. Let's see, we have about 4 minutes remaining, so I'm going to get one more question in here. And the question is, do you think that amassing significant reserves is problematic if you're practicing trust-based philanthropy? Do members expect you to distribute excess reserves to the community?
Yeah, that's definitely a fair question. I know a lot of foundations are asking that amongst themselves. I would think that your pooled grant fund is really where you're distributing those funds and making those grants. Your reserves are really to make your organization financially secure so that you can be there tomorrow. So that if an unforeseen event happens, like a reneging on a gift, like you've lost your building lease, like, I don't know, you need to give an emergency raise to maybe some of your staff, or you need to go out and hire admin staff because your volunteer army just threw up their hands and said, we're done. That's where your reserves come into play. Reserves are not meant to just stockpile money. That's why it's good to have a limit and a cap. 12 months is usually the cap of that. But again, that's a great question. And we could talk about that in the Let's Keep Talking session tomorrow.
Perfect. All right. Well, time flies, definitely. This went much quicker than I had anticipated. So thanks to Claire and Rebekah for everything that you've done and for serving as our panelists today and for sharing your wisdom with us. And we want to thank all of our participants today for joining us. We hope you learned something new. We have put together a document that contains more detail about financial sustainability considerations, which hopefully we're going to drop in the link here, or drop in the chat here. Nancy, if you can do that, and encourage you to review that, and then join us tomorrow for the Let's Keep Talking session, which is going to happen at 4 p.m. Eastern time, where we can continue this conversation. Rebekah and Claire will be hosting a breakout room, and they can answer any additional questions that you have that we didn't get to today or that come about by reading that document. You can register for the session by adding it to your agenda in the Whova app, and you'll find it under the network block section of tomorrow's agenda. Look forward to seeing you then. Sarah?
Yes, thank you so much. Thank you, Claire. Thank you, Deborah. Thank you, Rebekah. We appreciate so much your insights about this topic. And before we wrap up, please remember to answer our 2-question poll before you exit this meeting. It's just, you're going to see it right here. And also in the next few days, you will find a recording of today's session on your agenda, so you can, watch it again or share it with people. And thank you again for joining us. We look forward to seeing you at more sessions this week. Our next session with Philanos is the wisdom of younger members, how and why next-gen philanthropists are changing giving circles. And there's also a session with SVP partners that is called Journey to Reimagine Giving. And we'll see you there in about 10 minutes. Thank you, everybody.